let's pop live on the page. Now I gotta just share it out to the group and then jump on my phone and track. So some people can probably see us now if they're watching.
Cool.
And let me just get the shit out to the page and we'll get started.
Boom.
I wish there was like an automatic way to do this. Like, hey, go live here and then automatically share it here and here and here. All right, so let's pop live. Let's share it out to the group. And then I'm going to open it up on my phone in case there's like massive comments. Then we can get them addressed. All about how Trump's tax. I should have just fucking copied it before. Thank you. Fuck, man, I can't even type. All right. I keep spelling entities wrong. All right, so now we are fucking live on the page and in the group. Let me just pop open the page on my phone and see who's watching us, if anybody at all. This is the most unsexiest topic. Today we've been talking about unsexy topics.
Yeah,
Topic today.
I'll make it look sexy, though. Money's sexy, though, man. Damn, money is sexy, though.
Eric Nghiem makes taxes sexy. That's your new
cash
flow. Was it cash flow doctor?
Yeah, I'm Dr. Cashflow, man.
Dr. Cashflow. So we'll make it sexy again. So let me
make taxes and finances sexy again. I'm bringing sexy back. Bring sexy back to taxes.
Awesome. All right, let me just refresh the group. See who we got watching. Hey, if you guys are watching, leave a comment on either the group or on the page, and we're gonna dive into some unsexy stuff that Eric's turning sexy, talking about tax. The new tax, everyone's talking about the Trump's tax plan, just like when Obama came in, everyone said, but Obama said this was going to happen. And like, if you ever worked in an industry where you dealt with this on a day-to-day basis, all you hear is, but Obama said, but Obama said. So now we're going to move on to what Eric knows what I'm talking about, so he gets it. Now we're going to move on to what's Trump doing, how's it affecting the tax situation as a whole, more importantly, how it affects us business owners. And then we'll be talking a little bit about what you should be doing to move forward as far as how you should structure your company. Does it stay the same? Do we have to make some modifications? What the fuck do we have to do now? Because I have my shit how I like to do it, but now is this something different? So I have my buddy Eric Nghiem on. Eric, why don't you go ahead and introduce yourself, tell people what you do and your many accolades in the business.
What's going on, guys? My name is Eric Nghiem. I'm an enrolled agent based out of Southern California. An enrolled agent just basically means I have the ability to represent taxpayers in front of the IRS if they get audited, they get in trouble. I'm the guy that they call up. My company's called the Cashflow Doctor, and I'm specifically called Dr. Cashflow. So I'm here to make taxes sexy again, make taxes fun again. I've been in the business for over 8 years now, and that's how I became friends with Baldeep over here. We were deep in tax time, man. Tell you what, the stories we have, the stories that we shared, man, some crazy stuff. But yeah, I mean, we've both seen the industry evolve and tax changes come and go, and a lot of folks, unfortunately, a lot of tax preparers, a lot of tax professionals, they act like they're historians. And what that means is, Baldeep goes in to get his paperwork done with his tax preparer or CPA, whatever. Most tax preparers, they just take your paperwork, your spreadsheet, your profit and loss, and then they file based on it and give you back a number of papers. Say sign here, sign here, sign here, and sign here, and cut the IRS a check for $20,000, $30,000, $40,000, $50,000, $100,000 for tax bill, and they call it a day. And unfortunately, that's how most tax preparers work. Everything is super reactive, super after the fact. Hey, could I have done something different? Could I have changed something? Could I have reported some different expenses? Yeah, you could have, but that was 4 months ago. It's too late to do it now. So I like to change things around and run my practice a little bit differently. I like to do things proactively. And although I do have an accounting and tax prep component in my business. What I really enjoy doing is helping people build out tax plans and help them restructure their businesses and utilize all the different entities so they can participate in all the tax brackets instead of just the top ones.
Awesome, 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 Eric. So let's like dive right into the topic at hand.
Yeah.
What the fuck just happened with all these tax law changes, right? So from what outside looking in, like I don't get involved too much in the day-to-day tax office activity anymore. The general consensus for like offices that are filing now, I don't think much has changed just from what I've seen. But then you see like stuff on CNN and Fox and MSNBC. One says, "Hey, all this stuff is here. This helps Trump because of this," and like they all want to narrow it down to how it helps the president. But ultimately, the president doesn't decide your fate. How does this affect the average business? Let's start with digital marketers. Like how does that affect them?
Yeah, that's a great question. So let's totally separate politics out from this discussion because at the end of the day, the IRS sees all of our money as green. They're not racist to our money. They're not political to our money. They just like our money. So let's just look at it that way, right? And at the end of the day, the casino is the house, right? The IRS always wins. It's like the casino always wins. So at the end of the day, as business owners, small business owners, digital marketers, there's been a couple of tax law changes which are actually beneficial to us as business owners, especially when it comes to what they call pass-through entities. And, at the end of the day, being an entrepreneur, being a business owner is one of the biggest superpowers you could have today. You can control your own lifestyle. You can really build your own future. You can really build what you want to build. So if you're on the edge thinking of being an entrepreneur or becoming a digital marketer, this is a great time to really dive into it because the only real tax breaks out there for most individuals is if you were to own a business or operate a business. So let's first start with that. That being said, if you're a business owner and you have what they call a pass-through business, like a limited liability company partnership or a S corporation, there's a lot of new tax law changes which are super beneficial. The biggest one, probably the number one biggest one is these pass-through entities get an immediate 20% or up to 20% tax deduction off your profit. So if you're bringing a profit of $100,000 and subject to different rules, but if you're bringing a profit of $100,000, you're only going to be taxed on 80,000 of it, which is definitely nice, which is a huge benefit.
Okay, so pass-through entities. So instead of the conventional, how it used to work, where if your profit is $100,000, that K1, that pass-through to your personal return, is $100,000 that you pay your taxes on, depending on if you're married, single, kids, all that shit. So now you're saying that instead of the 100,000 going there, that same exact return is now 80,000.
Yes.
Oh, that's huge. And you did say something else, and let's clarify, because you said limited liability company partnership, and a lot of people may just confuse an LLC as a pass-through entity versus LLC partnership as a pass-through entity. So let's go ahead and explain the difference, because a lot of people, I can guarantee you, they've been told to set up an LLC, but don't realize how much it fucks them.
Yeah, that's the biggest thing too. Is like LLCs. You see a lot of like news and a lot of articles about people like, oh yeah, get an LLC, and LLCs are great, but they're not a tax-saving tool. LLCs are purely a tool that you use to save yourself from liability. Liability mean like, let's say if somebody was to take you to court, right, for something that happened to your business. An LLC would save you from that liability, and your personal assets would be saved. So, meaning, like, let's say if you had $50,000 in your business, you had a home, you had a car, and you did everything right. Something happened. Somebody was to take you to court. They could go after the assets in your business, but not your personal stuff. So that's the main benefit of an LLC. But for tax purposes, an LLC is what they call a disregarded entity to the IRS. Meaning the IRS really doesn't care. They're still going to charge you self-employment tax on that money. So if you're making I like saying $100,000 because everybody likes six figures, and it's a really easy number to say. If you're making like $100,000 in profit, you're going to be paying your ordinary income tax on it, regardless of what entity you're in. But with an LLC, if you're not being taxed in a special way, like an S corp or whatever, you're also paying an additional $15,300 of self-employment tax. That's the same as if you were a sole proprietor. You're paying that $15,300. So an LLC doesn't save you tax money. it only saves you from liability if somebody was to take you to court. That being said, there are ways to utilize the LLC by changing the entity or changing the way it's taxed. Pretty straightforward, easy ways to get that changed. Where now you could segment a portion of your income off as salary, let's say 30 grand. So you're paying 15.3% on your 30 grand, but the remaining 70 grand comes out without that additional 15.3% tax. So there are definitely ways to save money, and an LLC is not a tax savings vehicle. So that's a really good point.
Yeah, and it's funny because a lot of people, they do that, right? They say, oh, I'm just going to make an LLC. So really to clarify and bring that home, if you're an LLC and you're the only person that's owns the LLC, you're going to, out of that $100,000 example, you're going to pay not only the regular tax that you have to pay on that $100,000, but they're going to put another $15,300 on top of that. So you're not saving yourself anything. A way to save yourself that $15,000 is by filing one piece of paper, the Form 2553, if I'm correct, right?
Yep.
Form 2553 takes a few seconds, fill it out, and fax it in. And now, instead of being an LLC alone, you're still an LLC, but for IRS purposes, as far as tax purposes, you are what's considered an S corporation. So an S corporation is where these benefits that we're talking about are coming in, or an LLC, if you have a partner on it, is another type of entity like that. Right. So those are the most common ones, and correct me on if I'm wrong on any of that, but just wanted to make sure that was clear. And if anybody at this point, Eric, says, oh, I've had my LLC for a year, what do they do to restructure themselves? Like, let's give them a quick tip now before we move on.
Yeah. So an LLC, like what's really cool about it, and you can't do this as a sole prop or other entities. With an LLC, you could backdate to that previous year. There is a little bit of legwork involved. You got to write a letter to the IRS and ask for late election and all that good stuff. But you can, let's say you're in 2018 right now filing your tax return, and you're like, wait, how much do I owe in self-employment tax? You can go back and do a late election to get your company taxed as an S corp for a prior year. So that's a definite, like, huge benefit.
What happened to people that were about 2 years out, 3 years out? Can they still do that?
They still can. It's not as easy. And then you also have a balancing act because now you have to deal with the payroll that's like 2 years old, 3 years old, and the penalties that might be inflicted on that might not justify the overall tax savings. It all depends on the person's situation. But you can go back, which is really interesting.
And if you guys want to know a secret, like one that I use all the time when that shit happens, when you send that letter saying why you're doing it late, just blame it on the person that set up your company. Say they never filed it. And that's the easiest way to get it approved. And they'll never say no to that. From what I've seen, I've done a lot of times. Just tell them, hey, the person that was supposed to file that paper messed up and didn't send it. I need it. And there you go. Executive tip number 2.
Executive tip. Ball Deep's life hack. Ball Deep's life hack. Now, when you do get taxed as an S corp, there are a couple of caveats to it that you have to make sure that you follow by. Meaning, like, number one, you have to put yourself on payroll, because if you don't put yourself on payroll, you're not basically living up to the rule that you agreed to by running as an S corp. And then number 2, like what I'd recommend too, is if you are being taxed as an S corp, start operating your business as if it was an S corp. Start creating like annual meeting minutes. Start creating like an annual report on like what you're doing in your business. And that's for 2 reasons. Number 1, it shows that you are treating it like an S corp, being taxed like an S corp. But also number 2 is if you were to go to court and the judge was to ask, because what happens, a lot of folks, they go in LegalZoom, they file an LLC, and they just forget about it. If a judge was to ask in a court of law, hey, can you show me you're in compliance of like maintaining your corporation or your LLC, you could show your meeting minutes. You could show, yeah, I do my annual report. This is my annual meeting minutes. These are, I had my annual meeting and stuff like that, and show that you're in compliance and living up to the law of like why you set up the company.
Now, personal question, kind of. I have an S corp that I've never put myself on salary on. I've never heard anything about it from the IRS. So how common is it for you to even have to put yourself on salary?
Okay, so
shit, it's the fan, and you're like, oh shit, I should have done that.
Yeah, that's a really good question. So first of all, let me just start the conversation by prefacing that if you're an individual, as opposed to a separate entity, your chance of being audited is 10 times greater than if you were an S corp or LLC partnership or C corp. So the chance of an S corp being audited is much smaller. That being said, if the IRS was to audit for whatever reason and they found that you weren't taking salary, they could disallow the ability to take all those distributions without salary, without the Medicare, and just rack it all up on those years. So going back and fixing prior years might be very challenging, but moving forward, I would recommend to at least start putting on salary and make some document in your corporate book saying, I had no idea, or my taxpayer never made me aware of it, just so that there's some type of documentation that, like, from this point moving forward, you are doing this, and the reason that you didn't do it before is because the burden of the work or something. I mean, that might not be defensible to the IRS in audit, but at least shows that you did have a good cause, you did have some type of.
I think a lot of it. Correct me if I'm wrong. A lot of that stuff, like we're talking about audits, and like very rarely does it happen. Very rarely do you sit in front of a room in front of somebody, but I have had the unfortunate experience of having to do that on a couple of occasions, and I think it really comes down to that actual individual person. So initially, they're always out to get you. Like the fucking attitude I got, they're trying to. I'm like, no, dude. I was like, I'm sorry, no, can't help you on that. Like, just like the way they came across, they were trying to be so aggressive. Like, here, I'll give you a straight up example.
Yeah.
So I had in 2013, I had a tax liability of what I claimed was like 14 grand or whatever. But it really was like 35 or 40 grand. So I had 2 years of like high income single, single. So there's like a lot of tax money they want to collect. And then 2 years later, a lot of shit happened. I had net operating loss, all this stuff, but I didn't get a chance to file that stuff yet because I had to wait for some paperwork. And I had my audit, and the lady straight up said, "Look, where's the money?" Like, where's the money? I'm like, what are you talking about?
Where's the money?
Somebody straight up asked me, "Where are you hiding the money?" Like, it was insane.
Yeah. No, I mean, like, and I've been through a couple of audits, and it's interesting. If you go into an audit as a taxpayer, they're super militant, super like, I don't know how to describe it, but they're really aggressive because they know that people have the fear of the IRS, and they'll say whatever. But when you bring in somebody who's a professional or an enrolled agent or a CPA or somebody that knows what's going on, the number of things they could do is scaled down. There's been so many times where I would be on a conference call with an IRS field agent, and they would say things, and I'd be like, "Whoa, you're not legally allowed to say that," and they would have to stop for a hot minute because I caught them stating something that they shouldn't be stating, and that happens quite a lot. So, yeah, it's crazy the aggressiveness that IRS field agents have and desk auditors have because they know that people are afraid of the IRS and to get the stress and the anxiety out of their hair that they'll just do whatever and say, okay, yeah, fine, let me just cut you a check because the process, when it comes to desk audit or field audit, it's a hassle. They're digging through everything. It's like you're going for a colonoscopy or something.
Dude, they subpoena bank records, like so much to the point where they subpoenaed my sister's bank records because she deposited money into my account when I was traveling a lot. Remember when I was living in Mexico, moving around,
Yeah.
I couldn't just do shit. So like she had to take care of some shit for me. That they went and they subpoenaed her shit too.
Wow, man.
So they went
That's
hard,
crazy.
man. They went
Yeah,
hard. And they must be mad that they actually paid me at the end of it.
they really overreached on that one. You ended up getting paid. That's a great ROI for the IRS on that one.
But yeah, we got a question from Steph. Steph asked, how do you determine how much salary you will be getting? I hired an accountant, and this is what is happening now. So I guess assuming she has an S corp, how do you determine your salary? Especially if you're start a business, how can you even afford to put yourself on a salary because every month your income fluctuates?
Right, and that's a really good question. And so when it comes to an S corp, the IRS wants you to pay a reasonable and market rate salary. Now, we all know that businesses are just starting out and your cash flow is fluctuating. It's really difficult to pay yourself a market rate salary. So the best kind of like rule of thumb is up to $100,000 of revenue or $100,000. Let's clarify that $100,000 of profit. You're going to want between 40 to 50% of that profit to be your salary. Now that percentage changes as you go up. So if you're making $500,000, you're probably gonna be capping your salary out at like $80,000, $90,000 a year. And in most cases, the IRS is pretty cool with that, as long as, like, again, you're paying yourself a reasonable salary. And what you want to do is you want to find what your salary would be if somebody was to be hired in your company to do that. Now, if you're a company that's pushing like 30 grand in profit, your salary is probably minimal, $5,000 maybe, $10,000. But you do want to show that you are paying yourself a salary. The first like year or two, if you're not really breaking a great profit, I don't think the IRS is really looking at it because they're looking at low-hanging fruit. But as you start making more and more profit, you do want to portion off a portion of your profit as salary to pay that Social Security and Medicare tax, because that's really what they care about. They want to make sure you're paying your fair share of Social Security and Medicare.
Yeah, and once you guys start hiring employees, like the ones who haven't, you'll start realizing that that person that you're paying $4,000 a month to or $2,000 a month to is really costing you a lot more, because all those extra taxes you have to pay from the employer, it's significant. It is really significant. So when you start getting to that, there's a lot of other stuff that they don't really tell you. A $2,500 a month employee is actually a lot more than what you bargained for initially. So.
Yeah, you're probably paying closer to like $3,200, $3,300 a month for it, between the Social Security, Medicare, your half of it, your federal unemployment tax, your state unemployment tax, your workers' comp insurance, and all the compliance-related issues. Oof.
All that mess. Let's dive in. Darius Williams has a question, and well, this will probably dive into this. We talked about one benefit of the Trump plan for people, which is that now $100,000 in profit is taxed as $80,000 in a pass-through entity to your personal. Yeah. So great benefit. If you missed that part, go back and watch. But he asked, how do assets work now? Do you have to depreciate them, or can you write it off in the same year now?
It's kind of interesting.
Talk about that.
Now, before, what you could do is you would either depreciate the assets depending on what their longevity lifespan is, or IRS classification is, between 3, 5, 7, 10, 15 years. And you could accelerate it through using what they call Section 179, where you could just write it off at once. And now you're actually able to just write it off without taking any type of special election. But it's all capped out based on the overall revenue for the business. But typically, yeah, you could just go ahead and expense it. Vehicles are a little bit different. They did change some of the rules, and that's why there was a huge rush at the end of the year for people to buy like big SUVs that are over a certain weight because of the change in the depreciation of vehicles. But like smaller assets, I mean, you could take special depreciation and write it all off, which is pretty cool.
Awesome. All right, so that's another benefit. What else? What else changed in Trump's tax plan that's coming out, or lack of the new tax plan?
That's a good question. The next one that's actually interesting is the corporate rate tax. The corporate tax rate dropped from 35% to 15%, and that's what they call C corporations. And typically, the only people that would set up a C corporation are like big corporations like Microsoft, Apple, stuff like that. And the reason for them to drop the tax rate is to make it more appealing to keep business inside the U.S. But that being said, it does create an interesting argument for personal service corporations. So personal service corporations are folks like myself, accountants, attorneys, artists, stuff like that, where your actual revenue is driven based on purely your talent as opposed to the talent of your outsourced contractors or whatever. It's purely your talent. We don't have we have that pass-through deduction of 20%, but only up to $315 if we're like married filing joint, or $115,000 if we're single. So if you're making higher than that income as a personal service corporation, there is an argument to be said to utilize a C corporation. And I still use C corporations for clients that are doing pretty well with an S corp to allow them to deduct medical expenses and deduct mom and dad's daycare and some crazy stuff like that, which is really unique. And this just helps that additional creative deduction. So that's definitely a big one. And then the next big like business-related deduction is corporate alternative minimum tax has been eliminated, which is nice.
Corporate alternative or individual alternative?
Unfortunately, not individuals. I mean, that's the biggest, yeah, exactly. For the vast majority of us, we're mostly going to be hit by the personal one, but corporate alternative minimum tax has been eliminated. So it's not going to help the average, startup. Say again?
Does the corporate alternative minimum tax only affect C corps?
Yeah, because the S corp passes through to you
Yeah.
individually.
So for those of you who don't know what the alternative minimum tax is, basically this tax, it was a tax that was imposed back in the 60s, I believe,
Hmm.
to tax the higher income earners of America to put
Five
in.
guys, five people.
Yeah, right. And this was back in the day when $150,000 was a lot of money. So what happens was now $150,000 is not really a lot of money, and the tax rate stayed exactly the same.
Yeah,
So it didn't adjust for people's incomes to now be in the multi-millions or
right.
close to billions now, right? Like it doesn't adjust for that at all. Once you pass that, so what is the threshold now? Whatever that threshold is, once you pass that, you don't pay that extra tax anymore. So
Yeah.
it's basically keeping the people in the middle if you don't know how to structure other shit right.
Yeah, yeah, for sure, for sure. And it's one of the biggest, I guess, most confusing parts of the tax code because normally what folks will do is they take all their itemized deductions, they do everything they can to save on taxes, and they'd be sitting there scratching their heads like, how come I still owe the same amount of money? And then they look on page 2 of their tax return and say, what is this AMT, alternative minimum tax? And what you'll find is the more deductions you put in, the higher the AMT goes up to basically offset those tax deductions, which is a huge boondoggle for sure.
Oh, you cut out a little bit. So, but
Oh
yeah.
yeah, sorry.
So, basically, it's just one state moving it from one section to put it on the
Yeah,
other, and it's
exactly.
interesting. Rob has a comment. I heard that local tax deductions were capped at 10K. Is that correct?
Okay, so this is what they call. That's a great question, Rob. This is what they call SALT, and this is a big area of issue, especially for people that live in higher cost of living areas. Like for me in Southern California, the average house out here is $1 million. Like it's crazy. So typically before, when you're filing your tax return, you could take your property tax and you could also take your state and local income taxes. But now you can only take one or the other up to a total of like $10,000. So if you have a high state income tax and you normally itemize your tax return, and the reason that they did this is because they want to start doing away with itemized deductions. But if you have a high state income tax that you normally pay, you're capped out at 10 grand of what you could deduct. So one strategy, and again, I want to preface everything I say by saying that you should talk to your individual tax advisor or legal advisor before utilizing anything that I say, because everybody's tax situation is different. But one way to kind of alleviate that issue is if you're self-employed like myself or you're a business owner, you would portion out that part of the state tax that you'd normally pay from that income as a tax expense for that part of your income. So if you're a Schedule C, meaning a sole proprietor, solo guy, you would do it as a tax expense on your Schedule C as opposed to taking it as an itemized deduction because you're only capped at 10 grand. So there's definitely needs to be a little bit more creativity when it comes to filing your taxes now, where it used to be pretty straightforward. So it's kind of funny. It's like they simplify it, but you got to be more creative now to take advantage of what you're already paying. It's kind of crazy.
I like creative tax work.
And I call that expense and income shifting. It's totally legitimate. It's not a great thing. But now all you're doing is you're shifting the expenses from where it could be in a general area to the specific area to get that deduction, especially now where it's capped off. Same thing with like income. I like doing a lot of income shifting, like putting kids on payroll, and because if you're already paying for their private school, have them work for you, put them on payroll, and then use that payroll to cover their private schooling or daycare or whatever. I mean, there's a lot of really neat things you could do, and all you're doing is just shifting where the money is and utilizing it as a legitimate expense, legitimate deduction.
Ah, so that's a nice little thing. You put your kids on payroll.
Yeah.
But now going back to that, right, say you put your child on payroll, their private school is $30,000 a year, right? So you put them on payroll. You have to pay the self-employed. You have to pay the Medicare, Social Security tax, right? So you got to pay that. So it goes a little bit more than it would normally. But
Yeah.
the benefit is that now that all that 30K plus all that tax, you can expense against your your
Correct.
income you're gonna spend anyway.
Yeah.
So you
Correct.
might as well do that. But now does that cause a dynamic in the dependent return that now needs to be filed because that dependent will now have to do a tax return and may owe money because they don't have as much
Yeah,
benefit.
for sure. I mean, you got to definitely run the numbers, and that the kid's got to actually be doing a legitimate job. So if you got like a 2-year-old, unless they're like an Instagram model or a YouTube model or something like that, or just like
Oh,
a
so you
model, I
actually
mean,
have to you actually have to make them do work.
yeah, yeah. So like my son, he helps me file paperwork, shreds my papers, he checks my Ethereum miner every day. You know, he's got a real job, and instead of paying him allowance, I just do it as salary, and that salary goes right into his 401 his Roth IRA. But yeah, you can if you look at the numbers, if it makes financial sense, and you know if you get a $30,000 deduction and you're paying, let's say like $4,000 worth of taxes in order for that to happen, but you're getting a $30,000 tax deduction, and let's say you're in a 30% tax bracket, you're saving 10 grand, you're paying 4, your net is like a $6,000 tax savings. So it all depends on the numbers. It really does. But yeah, the child has to be doing a legitimate job, and you know a lot of people do it. You just have to document what they're doing and record
And
it.
not
And
get caught.
not get caught. What's legitimate? My kid shreds. He
Yeah,
files
but
paperwork.
you know when it comes down to it, they nitpick at every little thing.
Absolutely.
So you just got to make sure you have your ducks in a row,
Yeah.
regardless of the fact. And a lot of that comes back to being, like you said in the very beginning, being proactive, not reactive, right?
Correct.
Like back when I used to deal with clients and stuff, they'd come in and their W-2 withholdings would be like 5. I'm like, how many kids do you have? They're like, none. I'm like, okay, well, if you do something now, you can fix this for next year so you don't have to pay money.
Yeah.
And then the following year, oh yeah, I never did that. But as like a certain clientele, right? But if you're,
Oh, we know those clients.
because what happens is by the time you realize that there's stuff that could have been done, it's already the next year, right? So you have to be planning. Like right now, most tax people are not going to give you the time of day to plan. Just honestly, right? There's other stuff to do. So going to a tax guy in January to April in that time frame and saying, "Hey, can we spend a couple of hours on tax planning?" They're going to be like, "No." If they're any good anyway. If they have the time, then that would be very, very careful.
Right.
But they're not going to take the time. So doing something like that, if you don't know what you need to do, set up an appointment for May. May, June is probably the best time to get some really quality detailed time with somebody that knows what they're doing. Okay.
100%. That's a great tip. Great tip.
Yeah, dude. You don't want the people that can take you now. If they have time for you now, nah, not for
Nah,
me.
man, I'm like past my ears right now and stuff to do as a tax professional. If somebody's got a lot of free time, they might not have a lot of clients, and there's a reason for it.
So Darren asks, what about VAs that receive over $600? Are you W-9ing them even if you are paying through Upwork?
So here's the thing: is like you would only really need to get W-9s for VAs and contractors that are inside the United States. If they're outside the U.S., you have no reporting requirement on it. I would still keep records of who you're paying it out to, but there's no reporting requirement or 1099 requirement on paying or issuing it to people that are overseas. So that's a pretty good question because I use VAs in my business as well, and I have a combination of folks that are in the United States as well as in the Philippines. In the United States, I get W-9s on all of them because they're going to be making more than $600. But like everyone who's overseas, like in the Philippines, there's no requirement for it. It's just a line item expense on my S corp return as contractors.
Nice, nice, nice. All right. What's next? What's next? What else is good? What else is different? What else can we take advantage of legally or gray area that's right now?
Yeah. So right now, I mean, the biggest thing is like to definitely start considering being taxed as an S corporation or creating a pass-through entity to get that awesome tax deduction. There's a lot of really cool things with that. And as you start scaling up in income, what a lot of people start realizing is like, hey, I don't really need to utilize all this profit in my business right now. It's being distributed to me anyway. So what can I do with it besides reinvest in my business? So I always tell my clients, you want to take some money off the top to put into yourself, reinvest in yourself, not necessarily in the business, so that way you're building another asset outside of the business. So there's a really cool tool that I use for a lot of my self-employed clients that are one or two owner, usually it's married, or single owner like S corps, is to use something called a solo 401k. And basically, it's just a retirement plan that you can put your money into, get a tax deduction on it. Basically, it's right off the top. You're not paying tax on it. It goes into a retirement account. And what's cool about the solo 401ks that I use with my clients is it's self-directed, so you can put in whatever you want. So I got clients that are investing cryptocurrency in it, like Bitcoin and Ethereum. I got clients that are investing real estate inside of it. And what's neat is the plan provider that I use is they could get up to 50% of their account value as a loan immediately if they wanted to. So there's liquidity. So if there's a cash flow crunch, they have access to the money. And then they repay it based on an interest rate that they set. And now they're putting away like $55,000 a year, whereas if they're, in a $200,000, $300,000 income range, a $55,000 tax deduction is like the IRS giving you a check for like $25,000 to $30,000 to save for your retirement account. So that's a really nice benefit.
Is that the same as a simple IRA? What is that? Is that the same thing? No. So simple IRA is similar, isn't it?
Similar in concept, but not in the amount you could save.
Yeah, okay. Contribution limits. Is there a contribution limit in that?
So the solo 401k, the way it works is you can put up to your $15,500 and then up to 25% of your profit in your company. So if you're making like $200,000, you can put an additional $40,000 up to 55 altogether.
And
so it caps out at 55.
Like 5K contribution limit per year, like any other one, right? Or whatever.
Yeah.
Ah, yes. Interesting. And because it's self-directed, it doesn't fluctuate with the stock market.
It doesn't have to. I mean, it's self-directed, so yeah, you could invest in the stock market if you want, but you could put it in crypto, you could put it in like gold, or I've seen all kinds of crazy stuff.
So I know there's a lot of strategy where people take stuff like that and put it into real estate, because then all of the income that you generate in that self-directed IRA or whatever self-directed tool or vehicle is tax deferred, right? Or is it tax free?
It's tax deferred. Tax deferred. So you got to pay tax at some point, unfortunately. But it's tax deferred, which is nice.
All right, I'm gonna toss out another strategy at you, and I want you to tell me, is it something that would fly?
Got it. Shoot.
All right. So I am going back into real estate. I was doing a lot of flips and stuff in Texas and shit like that. Tomorrow I'm gonna be visiting Newark, New Jersey. And I'm going with a buddy of mine who has a lot of contacts in the wholesale market. People are bringing him deals. He has more deals than he has money that he can use. So along with that, I'm bringing my money guy who's got a lot of money. So we're going to go all meet. We're going to do all that stuff. I was thinking about putting some money into some projects there. The way he's structuring it for himself, because he just had a daughter, right? And I have a baby, right? You met my baby. Right, so
she doesn't like me.
She doesn't like you. She doesn't like Asians or Spanish people. And it's just the thing. It's just the thing.
Yeah, she saw me. She's like,
So, back to the topic. So what he does is, every actual unit, because it's a multifamily unit. So each unit has its own LLC, right? So it saves you if something happens to one unit that cannot affect another unit. That's going a little bit deeper than taking a whole property, right? Every unit. But what happens is the LLC owns it. You own the LLC, but the actual checks, the rent checks are written out for his percentage, are written out to his daughter's name and put into her account. So there's now when you're doing your shit, there's really no income for you to be taxed on.
Yeah.
And there's no requirement for her to file, really.
So the only challenge. So this is the challenge. So they're setting up LLCs for each of the units to save on liability. The only problem is they show the income going from the tenant directly to a personal individual that's not tied to the LLC. The court of law can look at it as a personal transaction, a sham transaction, and break the veil of privacy for the corporate veil, and basically nullify the fact of setting up the LLC. So that's like issue number one.
Okay.
Issue number two is, there's definitely an issue.
Okay. So what about I don't know if that's how I heard it when he told me about it. I mean, he has attorneys and shit that are handling it, so I could get more insight tomorrow. But then would it make sense if they pay the LLC, whatever Section 8, whatever's paying, then the LLC just distributes it out to a person to the daughter's account. It's already expensed out now from the company. Hits their records. Now it goes out. What happens there?
So if that was the case, then the LLC would get that tax deduction for the expense coming out, and then the daughter would have basically income. I mean, there's a more clever way of doing it where you could set up a management company in the middle and drive expenses into that management company to offset some of that profit that comes out. And then from there, the excess gets spit back out to the daughter. But there's a lot of like neat things that could be done with it. Like, for example, let's say this is like a more wider reaching type of situation. Let's say you have a retired parent and you have a house that you own in like Newark, right? And the retired parent is living in the home, and you're paying all the expenses for the home. You're paying the expenses for the mother, and you're not getting any type of tax deduction for it. But it's an income generating home. It could be rented out. You could definitely get a deduction for it. Instead, what you could have that person do is you could have the home as a rental, have the mom rent the property, so you have your depreciation, you deduct all your expenses from there, and then pay the mom for the management of the property to maintain it while she's living inside of it, for the down the road plan of you selling a well-maintained property. So all you're doing now is you're shifting expenses that were not deductible into a legitimate business expense because you're using it in order to maintain the property and sell it later. Shifting into a legitimate business expense, getting the deduction for it, and you're offsetting your income. You're deducting the stuff that you're originally paying for mom. It's like a home run. So with that situation, they could possibly run like a management company that they drive a lot of expenses into. Let's say like a C Corp that they end up zeroing out at the end of the year. But now that C Corp that's managing the LLC, all the medical expenses are driven into it, all of the, let's say the leasing of the vehicles and all that stuff is being driven into it, and that reduces the income, and then the excess gets spit out as payroll to the daughter. End of the day, their net in pocket is the same, like cash-wise, but their actual tax savings is significant.
Yeah.
You know? So and it's legitimate. It's legit.
A lot of shifting, a lot of moving parts. Let's stay on the topic of real estate. How has this new tax stuff affected real estate in general? Like people that are wholesaling, assigning, rehab and retailing versus buying homes.
So all that stuff really hasn't changed. They haven't really changed the way capital gains are being taxed. They did change what they call the 1031 exchange, which is what they call like kind. So if you flipped a property and you held that money in escrow and you identified a new property to work on, you moved the money to that property and bought it, and then now you're into it, you could defer your capital gains. They've changed that where it just is now just specifically for real estate. A lot of people thought you could use it for crypto or other things. It's now specifically for real estate. But other than that, like all the other real estate rules are relatively the same, other than the fact, like if you had a personal home, you can only deduct your mortgage loan of up to $750,000 of mortgage indebtedness, which doesn't really apply to the vast majority of the country, but like places like Southern California where your average house is $1 million, that does play an impact. But for folks who are like just flipping homes and they are or holding on to homes, it really hasn't changed much at all. I do see a lot of real estate investors that flip want to do everything as an LLC, but the only problem is when you flip, it's considered active income, and now you have self-employment tax. So I've been advocating a lot of them to consider either looking at an S corp or being taxed as an S corp to save on some of that self-employment tax.
Yeah. Yeah, active and passive. That's the big difference.
Yeah.
When you're active, dude, you're in for a world of hurt and that shit.
Yeah.
And you know what? People do slide by doing it how it would make most tax sense to them. And very rarely do people get audited for it. But when you do, you not only if they catch it, not only have to pay that shit back, but then you got interest and penalties to pay on top of it, which accumulate from the date. So
Correct.
It's not fun.
And then they start looking at the previous 3 years, and that ends up being a huge mess. So just to clarify, like active is like if you're flipping, you're actively renovating, you're actually putting labor into the property, whereas passive is typically the best explanation is if you're just renting out the property, it's mailbox money.
Mailbox money.
Mailbox money. I love that, mailbox money.
Darius is on fire, man. He's asking a ton of questions. What about the
Yeah.
death tax? Now, the death tax, the estate tax, whatever you want to call it, how does that affect the average person, if it does at all, and so forth? How's that working out?
Okay, so that the death tax is also called the estate tax, and the whole concept with it is if you had an estate of over a certain size, and the exclusions changed every year, and I think the last one was like 10 million, like 5 million for single and 10 for married filing joint. Like if you had over that amount of an asset or assets all combined, you would have to pay an estate tax on your estate, and that's why a lot of people set up creative like trust and foundations and had a lot of life insurance to basically cover that. And what happened was it's always been a contentious thing with the right side leaning part of Congress and Senate where they wanted that to be abolished or removed because they felt like, okay, if people have already paid tax on it once, why should they be paying tax on it again? It kind of makes sense. So they took that out in this latest tax law where they're basically limiting the estate tax. Now, for the average person, the vast majority of folks out there, unless you're the top 0.001% of the nation, you're probably not going to accumulate $10 million of assets in your lifetime. You know, it's a cumulative total of $10 million altogether at the point of death. And even if you were, like the vast majority of entrepreneurs that I know, they've set up their structures where things get passed on or donated through charity and all that stuff. So for the average entrepreneur, the average business owner, that's probably not going to be any type of effect on any of us anytime soon, at least I can see. But that's a great question. It's something that they always talk about in Congress. Oh, yeah, down the estate tax and these taxes for the wealthy. We got to bring these taxes down because it trickles down. I mean, let's be honest. I don't see Bill Gates give me any money. But at the end of the day, it's all it really does is it reduces the amount of income or tax revenue the federal government receives. And when the federal government receives less money but spends more money, that's like if you're making $10,000 a month, but you were spending $15,000 a month on your credit cards, and next month you only made $5,000, but you're still paying $15,000 a month on your credit cards. You're going to quickly go underwater. So that's basically what's happening. They're just cutting down the amount of revenue. That's it.
This country's built on. It's always
built
like
on debt. It's built on debt.
Awesome. Yeah, man. There's a lot of good stuff. And as far as pertaining to the actual business owner, there's a lot of other vehicles that people talk about that are not as commonly talked about, but I want to see does this stuff affect it? Now, what about the strategies of, putting stuff into insurance type of vehicles and things like that? So like if you go break down the different insurance types of vehicles they can use to purchase assets, things like how does that affect it in this whole scheme?
Yeah, got it. So there's two different specific segments of that insurance crowd. So you have the crowd that's making $1 million plus, and then they use what they call private insurance plans, where they basically are self-insuring, and this is pretty much more like a wealthy strategy. And so you're putting in $250,000, $300,000 into these insurance policies with a high deductible to cover your liability for your business. But that premium that you put in is fully deductible, and when you sell your business at the end of the road, you cash out your insurance plan. All of that comes out capital gain tax free, which is super nice. So that's more of the higher end tax planning strategy. For folks that are making between $70,000 to $250,000, there's a lot of folks that advocate putting money into life insurance policies so that way you can take the money out tax free and it grows tax free, and the way it comes out, you take it out as a loan. And the tax laws for that haven't changed. And the biggest thing that I would say is if you're looking to do a strategy like that, that should be on the bottom list of your priorities for investments, below maxing out your 401k or your solo 401k, below doing all of your other retirement-related plans like that, because typically life insurance is a pretty expensive way to invest. But it's, it works. But yeah, those captive insurances, private insurance plans, they work awesome. They're great tax deductions, but they typically only really work if you're profiting north of $1 million a year.
Awesome. So anybody have any more questions? If you have questions, we got Eric here. Start popping them below. I'm trying to think of more. There's like so much. there's like so much as far as like structuring things you can do. So many ways to take your cash, like so digital entrepreneurs, like, there's cash flow coming in, there's ways to invest, but a lot of times the information out there doesn't really give you the overall strategy of how do we put that together. So before, if people have questions, ask them. But if somebody wants to sit down and talk with you about their situation, how do we get in touch with you, Eric? How does that work?
Yeah, you can just pop over to my website and set up a call with me. The website is www.thecashflowdoctor.com. The Cashflow Doctor. Thecashflowdoctor.com. And I'll be more than happy to spend some time chatting with you. There's a contact button on there. You can set up an appointment to just chat. We'd love to have a conversation.
Yeah, guys.
Yeah.
Go ahead.
Oh no, I was just gonna say I just worked on a client recently. I did a really interesting tax plan for them, and they were an S corp, just like most other folks are. They do a lot of e-commerce selling on Amazon, do really well, FBA, drop shipping, and all that stuff. And they came to me and say, hey, this year we did really well, but we have a lot of things that we'd like to expense, but we can't because as a S corp owner, and you're more than 2% owner, you can't take things like normal auto expense or medical expense without considering it as part of your compensation. So what we did is I had built out a plan where they had a separate company that had ownership of the home office, had ownership of the vehicles, had ownership of the health insurance policies, and the corporation leased all that, the right to be able to use that from that other entity. And what that allowed that person to do is take all the mileage deductions, allow them to take all these cool deductions that they normally wouldn't have been able to as a straight up deduction. And it saved them, I think they were profiting like $450 a year, and just that lease back strategy saved them about like $38,000 this year. So there's a lot of really neat creative things that you do just by doing the right planning and working with the right people to do some right income shifting around to allow you to take advantage of tax breaks that you normally wouldn't be able to. And I mean, I'm sure there's a lot of folks out there that are, they're just writing whatever on the line and filing it. But if you want to do it right, you want to avoid desk audits, you want to avoid issues like that. There's a lot of great ways of setting it up and still saving money.
Let's dive into that strategy a little bit.
Go for it.
So, I probe, right? I'm going to ask you a lot of questions about that.
Absolutely.
So, especially coming into a space like you start having some money. Health insurance in the United States is not the cheapest. It is super expensive compared to everywhere else in the world, right? I fortunately still have my NOL, so I can take advantage of great perks. But I think it costs another year or two, right? I'm not going to be able to do that in the next 2 years. And a buddy of mine actually reached out to me sometime around open enrollment and said, hey, what are you doing on your S Corp for health insurance? They're like, there's no options out there for like good, affordable insurance that's not through a job that they give you for benefits. So let's dial in that strategy a little bit. And so what exactly happened? What is how does that affect their insurance rates? And also let's dive into a little bit more details on how that was structured.
Okay, so first of all, the rules are slightly shifting and changing. A lot of folks are only buying health insurance. Well, there are folks that haven't bought health insurance, and they had the Obamacare penalties or ACA penalties. That's all going to be gone in 2018. So that is one thing that changes. But when it comes to getting health insurance, it all depends because every state is different. So I'm in the state of California where it's relatively easy for a small business to get health insurance. And so what we do is we set up what they call a MERP. It's a medical expense reimbursement plan, but it's built into C corporation. So your C corporation would hold all of your medical expenses, your health insurance. Let's say if you had to get plastic surgery or eyeglasses or anything like that, things that are not normally easily deductible on a personal level, you run it through that conduit, that C corp. And then in the state of California, and again, every state is different. So certain states, it is more challenging to get insurance as a business as opposed to an individual. So you got to definitely talk to your tax advisor on it. But like in the state of California, it's relatively straightforward. And then we just run all of our medical expenses through this entity. Again, these are things that are not normally deductible. And I don't itemize because I don't own property out here in California. It's just way too expensive. And so now I'm still getting the benefit of all those deductions, and I'm still living up to the rules of of the S corp because I'm not taking it through the S corporation. It's not part of my salary. It's not part of my compensation. It's through another entity. So that's just how I do it. But everyone needs to be different.
That you said that because a lot of people feel that medical expenses can be deducted. And here's the thing too. People go and try and deduct stuff that's deductible. Like medical expenses are deductible. You can deduct them. But in reality, when you actually put those numbers on the form and the calculations are done, they have like zero impact on your actual bottom line on what you're gonna owe. They do not really affect shit. You need to have more than, at the time that I looked, it was 7.5%.
Yeah, now it's 10.
And now it's 10?
Yeah, now it's 10.
So now you have to have, now not only 10%, you have to anything more than 10% to even deduct.
Right.
So 10% of your income. So if you have $100,000 in income, you need to have spent more than $10,000 on unreimbursed medical expenses for you to even have a benefit. So that's still cash out of your pocket that you can't expend. You're still going to pay tax on, right? So this structure, you're going to spend the same cash, regardless the cash is you're spending it, right? It's going to happen. But now that $10,000 can be deducted from your income. You're not paying tax on.
Totally.
So that's really where these strategies come into play. Because when you start adding up those little shifts, right? There's stuff that people are like, oh yeah, I can deduct my medical. But yeah, you can, but it's really not doing shit for you, right? And people just like, I guess the general misconception, biggest scam in the world, cars for kids.
Oh God.
Right? So okay, like the reason why like I know about this stuff and like Eric's seen this, when you're in the tax bit, like I've been in the tax business, right? And there's advertisements around this time, donate your car for a tax deduction. Donate your car for your tax deduction, right? But then people come in with that piece of paper and you type, even if you don't know taxes, you type it in the software and you're like, oh, that did absolutely nothing for me. I just gave that shit away for free. And these guys went and sold it and made a ton of money. And they're just making money hand over fist on it. But you actually got no fucking benefit at all.
No benefit.
Just got marketed out of your vehicle for free.
Yep. with a fancy jingle, 1-800-CARS for kids. Jesus.
So, guys, like that's why it's important not to listen to the shit out there and just really find somebody that knows, like that has experience. Because even like me, I'm not an enrolled agent. I've just seen enough of this stuff going through my systems where I'm like, oh, even if you do samples and you have to download some free software, and you say, hey, okay, I'm at $100,000. What if I put this amount in deductions? And then you start realizing real quick that that refund number, that amount owed number doesn't change. You're wasting a lot of fucking money. You're leaving a lot of money on the table. And it's not so much cash out. Like, you're going to spend that money anyway. Yeah. But at the end of the day, in April, when you file your shit or do an extension, by the time your bill comes due, we want to make that $30,000 bill a $5,000 bill, and we want to do it in a way that doesn't get us into shit.
Absolutely. 100%. 100%.
Guys, ask us some questions. That's a good strategy. I really need to do more research on that medical stuff, but I want to find out how do I pay less to buy the insurance? How do I pay less to buy that? That's what I would do. Do I set up because companies to get medical insurance as a company, you need to have X amount of employees that are not related to you. Yeah. Right? And especially for like an agency like this, I'm not really looking to have too many U.S.-based employees. Really don't want to. So how do we do that? I need you to research that for me and find out how that works.
That's a good question. Because
at the end of the day, like right now, I'm fine because the NOL lets me get some nice, cheap, free health insurance on some occasions. So I'm gonna pay shit. But when I was paying it, it was like, for me as a single person, it was like $600 or $700 a month.
Yeah, it's expensive.
Yeah,
and for us younger folks, like, we're like,
it's gonna be like fucking $2,000 a month.
Yeah.
God,
that's a lot of money.
Yeah.
A lot of money.
Don't get sick.
That's the moral of the story here. I mean, there definitely needs to be some reform in the healthcare side of things.
What happened with that? Wasn't there a whole that didn't pass, right?
Yeah, they're still trying to do away with it. They did take away the Obamacare or the ACA penalties, and they did try to start taking away a lot of the ACA subsidies to the different states, but the states are having issue with it because it's a big part of their healthcare budget. So they're still working on that. That being said, yeah, health insurance is like really expensive, but there are, depending on, again, I'm not super familiar with the states of like New York and New Jersey anymore, but I do know that a lot of carriers do have like solo entrepreneur health insurance plans, but they are more expensive than buying it as an individual.
Yeah, and at that point it doesn't make sense. But I'd want to. We'd have to do a lot of figuring out. Will that extra cost, cash out cost, benefit me on the tax side? It might not. It might. Who knows, right? There's a lot of moving parts. And then let's be clear too, because I don't think we went into it. This tax law change, does it affect us now for filing or for 2019 filing for 2018? When does that effect take place?
Yeah, that's a good point. Good question. That effect takes place when you file for next year's tax return. So 2017 that we're filing for right now is going to be all the same as it's always been.
And that's
but this year coming forward, it's changed. Yeah.
That's a big misconception. That's why I brought it up. A lot of people think, oh, something passed in December or whenever it was approved, it's going to affect. No, because the shit was already in place for 2017. So all of this shit that we're talking about is not going to really affect you till 2019, right? But the benefit of knowing this stuff now is you can reach out to guys like Eric in May and set up an appointment, right? I'm sure they'll take a quick call now and push you out till May because any good person is not going to deal with you now, right? Take a quick call now, push them off till May, but now you start planning. And to be honest, I called Eric, 2 weeks ago? I called you 3 weeks ago?
Yeah.
I said, hey, Eric, I want you to handle my tax stuff. I have people that can handle my tax stuff. I have offices. I still have connections to offices, right? I still have the people that have done my shit all the time. Never paid for taxes. I never had to pay to get my taxes done. All my companies. I have a lot of companies. Never had to pay for it to get done. But I was like, hey, Eric, I think I need to pay you to do it just because I know there's certain things that you know that these people aren't going to know, certain things that you can help me in the planning and structuring for stuff that I want to do moving forward. And I think it's a good investment because if you can pay somebody $2,000, $3,000, whatever it is, right, and you know that investment will end up saving you $10,000, $15,000, $20,000, $30,000, whatever it is, it's take that all day.
It's a good ROI right there.
Yeah. And it sucks saying ROI because it's not really, it's like, it is an investment. It's like, yeah, I just pay less, right? And that's really what anybody that's saying they want to pay more is full of shit. And like they never had to be in that position of having done this shit to make more, to have to pay more. And I 100% agree. Like I 100% believe that. If you're in that, if you're saying yes, I want to pay more, dude, go into certain neighborhoods, go into shit, see the fucking way people live, right? And see the entitlement in certain areas, especially when you run tax offices and you see people coming in for money that is not necessarily earned. And there's a whole other conversation on that.
That's right? A whole other combo.
So put it simply, if you make between $10,000 and $24,000 and you have a couple of kids, you're gonna get a $7,000 check, or anywhere from $4,000 to $8,000, sometimes $10,000 from the government. And a lot of times refund checks for people in that income bracket are the same as their income the whole year.
Yeah.
So there's a whole different part of the world that you're not seeing, that when you have the money and you're like, why am I going to pay this tax for people that are not going to do anything but keep just taking the money and giving it for free? The government's just going to give it for free, you know? And that's all. If you have questions on that. So Anna asked, are you familiar with Florida taxes? So Florida is an interesting state because I'll let you explain, Eric.
Well, Florida, to be honest, I'm not super familiar with Florida. So
there's no state income tax, bro.
Yeah, I know there's no state income tax, but like, no. What's interesting though is what recently happened is a lot of folks were rushing in to prepay their property tax for 2018 because of the limitation on the property tax deduction for that year. So I had a lot of clients from Florida giving me a call saying, hey, should I prepay my tax? Like, yeah, if you can. But what happened was the IRS made an additional statement that said if you're prepaying property tax but it has not been assessed yet, then it doesn't count as a deduction for 2017. So
Some people trying to
yeah,
get their money back.
yep. So a lot of the municipalities in Florida are like, wait a second, what? IRS taking my money.
Yeah, but Anna also Anna, so yeah, Florida, there's interesting stuff with property and all that stuff, but as far as income tax, there's no state income tax, so that's one of the reasons why I've been talking to people and letting people know that hey, in the next few years I'm going to be moving to Texas because why should I pay, especially now that all my businesses I just sold off the last ones that are here don't require me to be physically in New York. Why should I pay New York an extra 20 grand to live here? It doesn't make sense.
Snow, right? You like the snow, don't you?
Fucking, yeah, right? I don't even fucking leave my house anymore. Ever. Right?
You're like blizzarded in, man.
Yeah, there was a blizzard, but I don't have to fucking do anything for it, right? Because I don't have to go. Like, I don't have offices anymore. I don't have to go anywhere, right? So it's like,
That's the
it's great. And especially this time of year, in the Northeast during tax season when you're running offices.
Oh, dude, that was the worst.
Horrible experience.
That was the worst.
Yeah.
I still remember one tax season, it snowed every single weekend during what we call our peak. Our peak season was from like the end of January to like mid-February. That's where we made a lot of our revenue. And for me, I had snowstorms every single weekend through that peak. It was terrible.
It hits you, man, because it's like you're looking at your numbers from the year before, and you're like, dude, we're not on track. Oh, but there's like been snow every single day, and nobody can come, and it's just a headache. I had a question I want to ask you, but it's slipping my mind. So while I try and recoup that, Key Van asked, what about retirement strategies? So you kind of touched on this a little bit, and it seems like there's a few more people watching now that weren't watching earlier. So let's kind of recap the retirement strategies while I try to think of what I was going to ask you.
Yeah, sure, totally. So there's a lot of really cool retirement plans out there for self-employed folks. If you're running like an S corporation that has payroll coming out of it, and it's just you or you and your spouse, you could utilize what they call a solo 401k, and it's self-directed, at least the ones that I use, and you could use that to invest in wherever you want, like cryptocurrency, real estate, whatever, and you can pop up to 55 grand into it. There's a lot of other really neat tools out there. I know most entrepreneurs, we're a little bit more aggressive on how we invest. We're not your typical like mutual fund, whatever kind of people. So there's a lot of like great self-directed IRAs, self-directed retirement accounts. Again, when they say self-directed, that means that you have control of what you invest in. It doesn't have to be stocks and bonds. It could be real estate, it could be gold, it could be Bitcoin, it could be Ethereum, whatever. But as a self-employed person, yeah, I would look at utilizing either a solo 401k because you could really max the thing out. If you're not looking at contributing a lot, you could look at a SEP IRA or a simple IRA, and those are great retirement planning tools. But if you are in a business like digital marketing, digital agency, where the sky's the limit on how much you can make, I would consider looking at a solo 401k because I've seen a lot of digital agencies start from like nothing and make. I have clients that are making 7 figures a year in their digital agency. So to be able to find ways to save money away, it's awesome.
Let's dial into that a little bit, right? So with the actual retirement strategy, the solo 401k, there's still people that are watching and that are in the group that maybe still have full-time jobs, right? Mm-hmm. So a lot of times when you have a retirement plan with your company, that's being invested into the stock market. And then what happens is those people are mismanaging your shit. People are stealing money here and there. That's why people's retirement accounts were disintegrated in a second, right? That's what happened years ago. I'm sure some people still remember that. So what are the options for somebody that still has a full-time job? Can they say, fuck you, employer, I want to take my retirement money and put it and contribute it into my solo 401k and you match my contributions there? Can they do that or no?
They won't be able to match in it, but that's an interesting question. It depends on the plan documents. So certain 401ks are structured where the employee could liquidate or transfer to another retirement plan while they're still in service or at work, and some of them won't let you do it. Typically, if there's a substantial match, like let's say you're putting in $5,000, your company's matching up to the first $1,000 or $2,000. If there's a substantial match, usually they won't let you do it. But I would check with HR and say, hey, what are my options on moving my retirement plan out? Now, if you could move it out of the company, obviously you won't be able to get the match from the company on your new plan, but what you're putting in through your payroll right now, you still can. But people can roll that into a self-directed IRA and invest in different products or different financial tools if they want to.
You can take that money, you can invest it in real estate, you can invest it in a business, and the profits that money makes stays as tax deferred. So you don't actually pay tax on that until you pull it out. But the trick is to borrow against it so you never pay tax on it.
Yeah. Yep. And
Awesome.
with a lot of these new self-directed tools, you can borrow it out at an interest rate that you set. It's still got to be market rate, but I mean, you don't have to.
Market what?
You can
So
charge
you charge yourself 1%. You can get 1% interest in this place. It's in the market, but when you really get fucking do that shit, you're paying fucking 8 to 12% or whatever, even more sometimes. If you're like me, you can take advantage of high interest loans. I just got one for 12% somewhere else. So
Hey man, if it's helping you make money or reinvest in your business, that's the cost you got to pay.
yeah, and the key thing there is that you can contribute more than just a simple That's why I asked earlier, because contribution limits, like how you're supposed to build a business off 5K. I mean, I guess in digital marketing you can, but like in a real asset type of business, you need more capital.
Right.
Awesome.
Yeah,
Does anybody else have questions? I can't remember what I was going to ask you. And that was so good too. If anybody else has questions, please ask them now. Eric's website is thecashflowdoctor.com. I went and posted it. People are already asking how to get in touch with you, Eric. He's making taxes sexy again.
Making taxes sexy. Oh, yeah.
Sexy, not again, right? Because it never was.
Super true. Super true.
Oh man, so yeah, let's close it off, I guess. What are the key things key takeaways people should be doing? We went over a lot, just break it down, bullet points for us on what to do for this new tax law changes and for planning.
The biggest takeaways is first of all, we didn't really cover it, but you want to try to get your
accounting straight. You can cover it if you have. Yeah. Let's cover it. I have time if you have time.
Absolutely. Yeah. So one of the biggest things I tell a lot of entrepreneurs before they even start wondering about what entity or how they're going to operate their business is to set their business up right. And what that means is you have a separate business bank account, business debit cards, business savings, whatever, that you don't mix with your personal accounts, because that's the one biggest issue that self-employed folks have when they first get started out. As they accidentally use their personal credit card for a business expense, or they take money from their business account because they need to pay themselves and they put it into their personal account, which is normally fine, but now they run expenses back into the business through your personal account. So you want to keep things separate from business to personal.
I do that.
The second,
mingled all the time.
Yeah, I used to do a lot of that, and it's easy to do because you got all the cards in your back of your phone or whatever. But what happens is when it comes to doing your bookkeeping or trying to reconcile what you did, it's just super hard to separate it. Because I know I go to Target to buy.
That's why you hire Eric to untangle that mess.
Yeah, I mean, we can untangle the mess, but if we keep things straight in the beginning, it makes things a lot easier and a lot more affordable for folks. So business bank account. Yeah.
Interjection question. I don't keep money in my personal account. I have a judgment right now, so I'm they took out $3,000 from my account, but I didn't realize I had money in my personal account. All of a sudden one day I'm like, oh shit, wait, I had money in there, didn't I? Fuck, it's gone. So now I don't keep anything in there until I get all that shit settled out, because I'm not trying to give people money that I don't want to give.
Right.
So I keep it in a company account. But what I do is I have a separate bank account under the company just for my personal expenses.
Yeah, as long as you separate it, that's nice. And then you just consider it as a distribution.
The only thing I can't do on I have my credit cards that I do put some business expenses on, and the reason I do it is because it has a higher limit. It's a personal card. That's the only time what I'll do is I'll charge stuff on there, and then I'll just pay it with my business account.
Yeah, I mean, at the end of the day, as long as you can understand the bookkeeping, and that's the biggest thing, is to be able to understand and explain to somebody what happened. I had clients that have come in, and I'm sure you can relate. I have clients that come in with bank statements or receipts, and they just dump it on the table and say, okay, this is my tax return for the year. And you're sitting there trying to sort through it, I don't know which is business and what's personal. and they wouldn't know it either. If you could clearly explain it and have a system for it, that's totally fine. I still recommend keeping it separate for the purpose of liability. But that being said, as long as there's an easy way to explain it, that's perfectly fine. So beyond,
they're gonna come ask you what you
yeah.
do with all that money. Ask you that.
The IRS agent, yo, what you do with all that money? Where you hiding it at? Where are you hiding it at?
What were you gonna say?
Business bank account, and then start considering to set up an accounting system. Either it could be something simple like an Excel spreadsheet to keep track of your income and expense. Because shoot, you don't want to like start getting advertising campaigns to expand your business if you're a digital marketer and not really keep track of your ROI and like how much profit you're actually making. Because you might be going negative. You might be making a ton of money, or you could be losing money. So keeping at least a spreadsheet or even using a bookkeeping software like QuickBooks or Xero or something like that would really help you not just maintain your business, but also grow your business. Because once you know where your profits are coming from, you could double down on those profit-making areas. Yeah. So those are the biggest two.
I use Wave Apps. It has like a bookkeeping accounting thing in there, which I'll probably give you access to sort my shit. But I use that because it also does the recurring billing and stuff, so I can use it for both, and it's free, so I don't have to pay Xero or anything like that for those functionalities. Robert has a question. When we work with resource partners, we get those expenses on which form?
When you work with resource partners, meaning like contractors you contract work out to?
Like outsource partners, like Invisible PPC or those types of companies.
So typically, if it's like a corp to corp, meaning you're a corporation and the other person's a corporation, or like Invisible PPC, I mean, I use like SEO Sherpa and stuff like that for my digital marketing business. If it's corp to corp and you just have invoices, you just use those as line item expenses. If you're working directly with contractors, like individuals, what you want to do is when you start working with them, before you cut them the first check or before you PayPal them the first amount of money, make sure you have their W-9 on file. Say, hey, before I could send you any money, I need you to fill out this W-9 and sign it. And a W-9 allows you to record their either social security number or employer ID number so you can issue a 1099 at the end of the year. And what I see a lot is a lot of people just start paying it, and then when it comes to get their taxes done and they need to issue 1099s, they try to email these people that they did work for, and people are like, nope, I'm not going to give you my info. I don't want to pay tax on that money. So always get the W-9 up front before you start paying contractors or resource vendors like that. But larger ones like big agencies like Invisible PPC or the bigger agencies, because it's corp to corp, if they just provide you an invoice, it's usually sufficient. Just like the smaller individual contractors need EINs or social security numbers for.
Yeah, anytime you're giving out, and I still have to collect some EINs and W-9s from some people, but yeah, from experience of being audited by the labor boards, if you're ever writing a check and that to a personal person and you don't have an invoice from them, they're going to classify them as an employee and charge you fucking, it's a mess. It's a fucking mess. If you're just trying to be lazy and just like, oh, fuck, I was writing you a check, and it doesn't go through the payroll systems and all that shit, it could cause you a lot of headaches. So I've been there, done that.
100%. Yeah, that's a huge thing, too. I mean, that's a good point you bring up. I mean, a lot of states are really hard-pressed, and even the federal government, hard-pressed on the classification of employee to contractor. And basically, if you're telling a person when they show up, exactly what to do when they show up, and you have to teach them everything, they're an employee. Now, if you just tell them a project, you say, okay, I have this amount of pay rate for this project to get done, and they're contractors, and it's much more clear. And the difference between employee and contractors, employees, you pay them an hourly rate, but you also have additional costs on top of that, like your FICA split, your unemployment insurance, workers' comp insurance, and everything.
Yeah, it's super important because you know what? This is an important topic. The reason why a lot of people ask this question in groups and in other groups, and they're like, oh, well, what if I just have an independent contractor that I hire in the meantime to start making some real money, then I can put them on the books, right? But the second you tell them what to do, you give them the hours they need to work, you're already fucked.
Yeah.
Right? If you sure, there's okay to provide a contractor, here's the generic instructions, but if you're training them, you're saying you have to be here from this time to this time, you fucked yourself already because now they're an employee, And here's where it doesn't matter if they here. How do I say this tactfully? Okay, everything is good until you let them go, and then they go and try to file for unemployment.
Yes.
That's when you get fucked, right? Because they're gonna say, "Oh well, you know what? Everything was nice. We're friendly. Yeah, you know what? You don't have to pay taxes on your stuff, right? And then I don't have to pay extra taxes on me. All that money's yours net. We're paying you 700 a week in your pocket, not 500 after taxes."
Right.
And then they lose their job with you. They stop working with you. You have a falling out. Even if you leave gracefully, I'll say, hey, there's no more work anymore. They're going to go to the unemployment office. They're going to show them the checks you gave them. They're going to say, all right, they worked there, and then the investigation starts. And then now, not only that person, but now they're going through all your records, all your shit. And you're going to fucking pay a lot of money out of that shit, too.
Yep.
So
You're screwed.
The second they hit that unemployment office, your relationship's over.
Yeah, you're screwed.
So, dude, we covered a lot of different stuff. A lot of stuff that. Here's the thing: there's a lot of stuff that people don't realize affects them or how it works because they've never been in business before to see that stuff happen, right? Like people are going through growing pains right now, and you're gonna run into a lot of shit that you could have saved a lot of money on if you just spent some time talking to people that actually did it. Or actually went through it, right? Someone like Eric, I know he has built brick and mortar businesses. He is specializing in working with digital entrepreneurs right now. As far as on the tax side, he has his own digital agency, so he knows the actual brick and mortar side. He knows the entrepreneurs on the internet side. And as far as to give solid advice and stuff like that. But like these are things that nobody talks about because most of the time they've never experienced it. And I'm sorry to say, a lot of the people that create courses never experience this stuff to even know that these are the shit that's going to happen. And it costs you a lot of fucking money. It costs you a lot of money. I've been fined a lot of money on shit that I just didn't know or I thought was, okay, let's just get through it. I thought it was small enough. And then you realize you're not that small.
Yeah.
Right?
Totally. It's not just money. It's also time. Oh, God. Going through audits and dealing with the paperwork. A lot of time.
Yeah, and they're going to ask you, in those audits, they're going to ask you stuff about, like, what is this, like, literally line by line. What was this for? What did you spend $14,000 on this for? Like, what did you do this? Like, literally, those are the questions. I'm like, what? I don't fucking remember. Like, you know? Because back then, you know, I used to just pull out, like, 10 grand in cash and go to strip clubs and shit and just, yeah. That's what I used to do.
Cash in a flash.
So, yeah, there's a lot of stuff to look out for, guys, especially as you're starting to build your business. There's stuff you need to know how to structure to save money. And when you're starting to hire that first employee, don't go running to like ADP or Paychecks or any of those. You don't need those yet. You probably never do. Like there's other companies out there that are cheaper that'll do it more cloud-based, like Gusto. I hear they're good. So
really good. I use it a lot.
Yeah. So like start looking around on what your real needs are. And if you don't know what your real needs are, speak to somebody who has been there or has experience in guiding those types of businesses, because people don't know what they don't know or they don't have experience in. And a lot of the people out there, you know, you don't want to be caught in like a new industry, especially like crypto, right? A lot of shit's happening in crypto right now, and there's a lot of changes. I know Eric's on top of the crypto stuff going on right now, but there's a lot of implications involved. So who are you going to reach out to? Your fucking regular CPA or a attorney or tax lawyer, whoever you go to, may not know the ins and outs of that. And even let's even go so far and say, I will say this straight up publicly, most CPAs do not know how to do taxes. And so don't think that going to a CPA, they know taxes. They went to school for public accounting, not taxes. Maybe they specialize in taxation, they'll know that. But for the most part, they just took like one course in college on taxes.
Yep.
That's changed since they went to college.
Yep.
Am I right or right?
100%. And, you know, on that too, I've seen a lot of work come up from tax attorneys because all they really do is they focus on representing people as opposed to actually work on tax code. I've seen a lot of bad work from tax attorneys too. So I'd be careful of who you work with and who you're utilizing and trusting to work on your stuff.
Yeah, the reason why, and most people have never heard of enrolled agent credential, and that's what Eric is, an enrolled agent. And the reason why most people don't hear of it, because it's not something you go to school for. It's not something that people talk about. It's a special training course that you have to pass. It's a special exam that you have to pass, given to you by the IRS, that says that you're an expert in taxation. And it's a 3-part thing. It's not easy.
Yeah.
It's not easy. And on top of that, you need to get continuing education every year. Is it every year or every 3 years? Every year.
Every year. Every year.
Every year, you need to have continuing education, not on all this other crazy shit that CPAs have to get continuing education for, that attorneys have to get continuing education for, on just tax continuing education, which is a lot about the structure, like a lot of the law. But when you start looking at the law and you start looking at that shit, you realize how you can do the planning and the shifting to benefit your client.
Yeah.
So I would always recommend going to an EA for tax planning. Go to an EA versus anybody else.
Yeah, 100%.
What course says that you are an expert by the IRS? So it's in the enrolled agent examination, right? That's what it's called?
Yeah, they actually call it the SEE. It's like special enrolled. I don't even know what it means. Examination or something like that. The C exam. But it's a bomber, like 3-part, 3 different tests. It's very challenging.
Yeah, it has personal, individual, corporation, business, and then ethics or some shit.
Mm-hmm.
Yeah, well, the ethics is there just because they don't want people to, do some shady stuff, but that happens. But yeah, it's a special test that's just administered by the IRS for that purpose, for people to go and represent you. So I always suggest, for attorneys, seek out a specialized attorney in that space that you're looking for. Like if you're looking for contract work, find a contract attorney. If you slip and fall, go to a personal injury attorney, right? Everything's specialized for a reason. Even medical is specialized, where
exactly.
You fucking have heart problems, you go to a cardiologist, right? You have fucking whatever, you go to this. Like everything is specialized, and this is no different. Tax attorneys are for when you get into real shit, probably, right? Like, oh, okay, we need a tax attorney for this.
Tax court.
Yeah, tax court. EAs can represent your tax court, but they're probably better served as planners and to do your returns, things like that. And a CPA CPAs can do taxes. Depends on their specialty. Just focus on what their specialty is.
Totally.
Yeah, dude. We got a lot of shit covered today.
We covered a lot, buddy.
And there's still people here. I'm surprised. So,
because I'm making taxes sexy, man.
Yeah, so guys, if you have any questions after the fact, Eric's in the Business Not Bullshit group. If you're watching on the page, make sure you join the group. You can tag him in there. His website is called The Cashflow Doctor. Go to that. I think it forwards you to dynamic.tax or something, right?
Yeah.
Okay.
I'm getting it rebuilt right now.
Yeah, okay. thecashflowdoctor.com. Check him out if you have any questions about your specific situation. We give a lot of details here, but everyone's situation is different, somewhat, generally. A lot of it's generally the same, but, somebody may have a different scenario that'll affect you that you need to know about, and you need to disclose everything to that person. So, guys, it's been great. I love the engagement. If you have any questions, just comment on the videos after, tag Eric, and I'm sure I'll be happy to answer it. Reach out to him. Yeah, I think that's pretty much it. Awesome. That was a good call.
No, man, thanks for having me on.
Awesome.
Thanks for having me on.